Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Jeff Dorman, chief investment officer at Arca, an institutional grade financial services firm building products utilizing and investing in digital assets, to discuss a use case for digital assets and ESG, as well as the revolution that's been building for 12 years. Jeff, it's great to see you as always. Welcome back to Trade Talks.
Thanks, Jill. Happy to be back.
Last time we spoke, you mentioned that there's an ESG angle to digital assets and bridging the wealth gap. Tell us more about that.
Sure. And ESG, obviously, environmental, social, and governance, right? What we're really thinking about here is how do you democratize the value capture of the investment world here, right? Instead of having your shareholders be some completely distinct, separate group who gets all the financial benefit, while all of your customers and users and other people who are stakeholders get nothing financially, what digital assets are really doing is it's starting to bridge that gap. It's turning all of the constituents that help a company grow into the people who get financially rewarded, right? Your customers, your developers, your early stage investors, your founders, and anyone else that makes this ecosystem work. That's who ultimately gets rewarded financially as the token price starts to go up once a network or a company starts to grow. So in that way, we really believe that tokens is probably the greatest capital formation and company bootstrapping mechanism that we've ever seen, because it really is aligning all parties, right? It is putting all parties together with the same incentives, the same alignment, and that's why it's fostering such rapid growth. And on the governance side, it's also giving these token holders the right to actually dictate and help change how a company or a project distributes those cash flows and how they make investments into other projects. So you have both the governance angle and the democratization angle. And I think in a few years, this is going to be a big part of ESG investing.
Let's talk about the timeline of Bitcoin and where we are with DeFi today. It's essentially started in 2009. And what do you think that was born out of?
Well, I think you could go back to general just mistrust of banks, right? I mean, Occupy Wall Street, for those who are old enough to remember that, was a really powerful movement 10 years ago, right? Talking about, we basically saying we don't like the way we're being treated. We don't like the banks being bailed out at the expense of everyday people. It was a good movement, but there was no solution, right? There was no ability to do anything about it other than complain. Well, you fast forward 12 years later, and there's still obviously some mistrust and inequality and anger out there. Ultimately, what people are saying right now is we want to have more control ourselves. We want to be able to get rid of some of these middlemen that are controlling everything and take back some of that power and some of that control. So I think it started in 2008 and 2009, and it's really just been continuing for the last 12 years in certain forms of social unrest. And decentralized finance, in our opinion, is really the first solution that we've ever had, right? It's one thing if since the inception of banks, I guess banks have been using and investing, investing in digital assets really difficult, right? Like there's no connection between the two worlds. That's fine if you want to have a distinct digital asset ecosystem here and it's the distinct equity and bond ecosystem over here. But when banks and brokerages start restricting what assets people can and can't trade and making sweeping decisions with regards to where you can send your money and how you can spend your money, it starts to rekindle a narrative for why decentralization is so important in the first place, right? Rules and regulations are fine, but arbitrary restrictions and dictatorships are where people start to really get upset. So that's why I think decentralized finance is taking off so fast right now. It's finally the solution to the problems that have been bubbling for 10 or 12 years with mistrust and centralized ownership.
Right. And I'm glad you brought up the concept of regulation, because Jeff, just to push back a little bit here, some level of regulation is necessary, even though, this was created out of this theme of decentralization. I think it would be irresponsible not to have any kind of regulation in the space.
Yeah, I completely agree. I mean, we at Arca, we are pro-regulation. We don't think there's any issue with regulation. I think part of the reason this space is mostly unregulated right now is because the regulators are actually being smart, right? You don't want to put sweeping regulation into something that's evolving every minute or every month, because as soon as you get it out there, it's going to be obsolete. So they're learning, they're taking their time. And in the meantime, there's this regulatory gray area with a lot of things that are happening in digital assets. But it's probably better to let it germinate in this gray area until we figure out a good solution, rather than rushing regulation that ultimately is going to be stale and stifling and really limit the power and growth of this decentralized ecosystem. So we're all for the right regulation when the time is right. I think it just takes some time to get it right.
And you noted in a blog as well that this could also be part of the get out of cash conundrum. What do you mean by that?
Well, I think, central banks around the world have basically been daring you to own cash, right? You're getting negative interest rates in some cases, or at least very low interest rates. You have inflation, you have money printing going on everywhere, which is going to lead to further inflation. So in general, there's this attitude that I don't want to hold on to cash. In fact, for the first time ever in my career, I know people who got year-end bonuses and are like, I don't know what to do with it, but I don't want it to sit in cash. I've never heard of that before, that people are afraid to let it sit in cash. So everything you're seeing right now, from the rise of Reddit powered stocks to the rise in real estate to the rise in digital assets, is some component of the dollar is going down, interest rates are low, I want to put my cash to work. Digital assets are not unique in that sense, but it certainly is a powerful backdrop from a macro standpoint that is powering all risk assets right now.
And Jeff, with all that said, risk management does matter. I believe it's prudent to have a working knowledge when it comes to trading of any asset. And I also believe that understanding risk first before calculating profits is important as well. Would you agree with that or not?
Yeah, I do. I mean, I've been in asset management now for almost 2 decades, and there's three things that investors will tell you always get a fund in trouble, or even a personal investor, right? One is shorting, one is using leverage, and one is having illiquid assets. And we just saw that pop up in the last 2 weeks with a bunch of high-profile hedge funds, either going bankrupt or certainly having very poor returns because of shorting too much or using too much leverage. Just because you're in an asset class, whether it's small cap stocks or high yield bonds or digital assets where there's a lot of risk, doesn't mean that you don't need to take risk management seriously. And I think that's where some of the disconnect is when you talk about some of these asset classes. Is just because the underlying assets are risky doesn't mean you have to have an overly risky portfolio. There are tools to mitigate some of that risk. There are portfolio construction tools to make sure that you don't have all your eggs in one basket, or you don't have high correlation between different assets. So I think last week and the week before with the Reddit powered short squeezes, I think it's just a very good reminder that you can learn how to trade in a day, but it takes decades to learn real risk management, and both professional investors and retail investors need to take that seriously.
All right, Jeff, great to catch up with you as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.